You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Thank you for tuning in to the Generational Wealth Through Commercial Real Estate show. I got a very special guest lined up for you today, Jennifer Grimson. She is a single mother who lost everything. Well, she was a single mother who lost everything twice. The second time, she rebuilt by creating small empires for financial independence. She created over $1.4 million in income producing investments with a W-2 and with some grit. In 2019, Jennifer created the Micro Empire podcast to show her story and to pull back the curtain on the path to financial independence. Jennifer, how are you today?
Hey, I'm great. Thank you so much for having me on. I appreciate it.
Absolutely. I'm excited to hear your story. I appreciate you reaching out to me through our mutual connection, Yona Weiss. But yeah, tell us who you are and how you got your start in real estate.
Okay. I'm somebody who I think is actually, my story is not unusual. I'm somebody who made a lot of financial mistakes, and my mistakes were not about buying expensive clothes or cars or that I had to have the best purse. My mistakes are around relationships. I made relational mistakes, which is very common for women, maybe for men as well, but for women mostly. And I'm somebody who also worked as a corporate executive. So I was a sales executive for 25 years in healthcare technology. I never say no to opportunity. It sounds like you're kind of that same person. So I never say that it's what I did do, because I could always go and do it again. And, but, looking in from the outside, you would think, well, somebody with a good job and a good income, and how could they have lost everything? Not once, but twice, because it wasn't so, I had to do it twice. It was so great.
Right.
And also I'm not uneducated, I'm an educated person, both in just my own, I don't mean that by having an advanced degree, but that doesn't necessarily mean it, but it's not as if I didn't understand money, didn't understand the importance of money, or savings. And yet it happened to me. And so by starting the podcast, the other thing is I had kept it a secret for a long time, which I think is pretty common. People have a lot of shame around their money.
Right.
And I talk a lot of to people about their money culture, how they grew up and how they live now, et cetera. Because it really does define. But starting the podcast meant that I had to tell the story and be honest about it. So now everybody knows who cares to listen.
Right. No, that's it's very, very interesting to hear that story. Because most people think when somebody is broke, it's because, they, are uneducated, they're lazy, they don't want to go out and work hard. But that wasn't the case with you. It's just, life happened, and, you lost it not only once, but twice. So what I want to do is I want to dig into that mindset of how you got back up, because a lot of people fall and stay down and never get back up, but you got back up. So let's talk about that mindset that it takes to be that type of person.
Okay, great. Well, it started where I married very young. I married basically my first boyfriend, and I was still in college. And I married somebody who, this is the thing that I talk about a lot, understanding your own money culture. I grew up in a family where very conservatively, don't live beyond your means, don't use a credit cards, a little bit of fear around taking risks, a lot of fear around taking risks.
Yeah.
I was the youngest of 6. My father was an engineer, but there were 8 people in the house. So even though he had a good income, we lived pretty modestly, I would say.
Yeah.
That's how I was raised. I married somebody who was completely outside of my money culture, who money represented a lot of emotional things. And so we lived in financial chaos is what it was, which I think is also very common. You may have one saver, you may have one spender.
Yep.
living together. And that is, I mean, the majority of divorces are based on money, honestly.
Right.
So there was the living in the financial chaos, which was all of my 20s. And at 29 years old, when that marriage came apart, I was, I'll make a very long story short, but I was awarded custody and I moved back across the country. I was living in California, back across the country to New England to move back into my home. But part of what I did was to try to expedite things was I just walked away from everything.
Right.
There weren't a lot of assets, but in some cases, and I can think of a lot of examples, women walk away from what they have the right to do because they don't want to fight, or because they feel guilty, or because they think it'll be fine, I can handle it, I can take care of myself financially. But in my case, there really weren't a lot of assets anyway. I moved back to New England. So that was the first time I didn't have a place to live. I moved in with my mom with my two children and my suitcases. I didn't own a car. I didn't have any money. And I was starting all over. And that's when I got into sales. And I started selling, just sales and technology in general, and had a lot of success in that. I was really driven because I didn't want to. I lived with my mom for 2 years, 9 months, 8 days, 49 seconds, as you can imagine.
Right.
And to be fair, it was harder on my mom. I mean, can you imagine? Your 30-year-old daughter moving in with her at the time. Then they were 3 and 5. They were 1 and 3 when we separated, my kids.
Yeah. So
I rebuilt and built a house next door to my mom, which was a huge accomplishment. But that's really, my divorce is what landed me there. But then my ex-husband sued me 25 times in 10 years.
Shucks.
And and that happens.
Wow.
And that, if people want to be litigious, they can be litigious.
Yeah.
And that was to the tune of $500,000. So what I realized was that if I filed Chapter 13 bankruptcy, he also sued my family members. If I filed Chapter 13 bankruptcy, I could protect my home and I could stop the lawsuit. So I did that, and it was a strategic move. Yeah. That ruins your credit for 10 years.
Right.
So worse than bad credit is no credit.
Yeah.
So that was round one. And I thought, I still had the mindset, your question was about mindset. I still had the mindset of, okay, I'm just going to work real hard. I'm going to get another job. I'm going to earn more money. I'm going to be the best salesperson. And that's what I'm going to do. Well, that's what I did. I ultimately ended up working for a company here in Nashville, Tennessee. And I was in a relationship with someone here in Nashville. So I moved here with my children, and my mom also moved here. And we were in a relationship, and about 3 years into our relationship, my ex-husband was still suing me.
Yeah.
And I was still working to pay those bills. So making a lot of money and having nothing to show for it.
Yep.
And it occurred to me, and my boyfriend at the time was asking me to quit my job. He wanted me to move in, and he wanted me to quit my job. He had the means, and he was saying, why don't you relax for a few years and don't work so hard? And it occurred to me, if I take away all my income, or the majority of my income, you can't get blood from a turnip. He keeps suing me because I'm making a good amount of money.
Right.
So I moved in with the boyfriend, and I quit my job. I took on a part-time consulting position and filed for Chapter 13 bankruptcy again, because you can do that. Wow. And the message really is, if my credit was already ruined at this point, it was like, what do I have to lose? Right. And you can continue to do that basically repeatedly if you're a person who needs to do that, which hopefully these are extreme circumstances, and hopefully nobody ever has to do that. But what I'd done was I'd kind of closed that chapter, kind of took away the ability or the desire to keep lawsuits when I had no money left to come after. I didn't marry my boyfriend specifically because I didn't want my ex to have access to him. So strategically I did that. But what I had done was jump from one problem to another, which is I turned my financial well-being over to someone else.
Yeah.
So living with the boyfriend who was well off, and he owned the car, he owned the house. So 4 years later, when that relationship came apart, I found myself again I didn't own the house, I didn't own the car,
Yeah.
have any savings, and here I was having to start over again. And now I've been out of the real corporate world for 4 years.
Right.
Further, and I won't go into this too much, was I did have a $47,000 old 401k, and I thought, well, for sure, I'll have that. If anything happens, I can have that. And I had taken it from the company I was in and given it to my boyfriend, who had a company, who had said he would set up a 401k and it would go in there. He cashed that check.
Wow.
Yeah. So I didn't have my 47,000. And then because he cashed it, you know what else happened? There were taxes and penalties. So it was only really worth $29,000. But in the end, let's just say I could be really aggressive, and I got at least my $29,000, and I negotiated a car.
Right. So let's talk about, how did you, we seen how bad it got, that was pretty bad. How did you get from there to where you are today? Because you're doing some great things today. So let's talk about that journey.
Yeah, I think that's really when the mind shift changed for me, because I realized then, like, I could work 3 jobs, 5 jobs, 10 jobs, but that was never going to give me the security that I needed. Yeah. And I just determined I am going to, whatever I do, I'm going to have pockets of wealth. And I use finger quotes because wealth is not a certain number for me. It's how it makes me feel emotionally.
Yeah.
So I did. I started working, but I also started realizing, like, I need to rebuild. And for me, it's going to be real estate. First thing I did, it took about 3 years for me to rebuild credit. Then I was able to purchase a house, which is a miracle. That's a story in and of itself. And then in 2014, I found Airbnb. And I immediately started renting out my house, which at the time people thought was radical.
Yeah.
But it immediately started renting in the city that I'm in, just constantly. And I realized, wow, I'm onto something. I'm going to do this again. And I bought a second house, and I joined an real estate investor group, and I started learning all the tricks in the language. I didn't know about a self-directed IRA. I didn't know I could use my 401k. I didn't know I could borrow against. So those are the things I did. I used those tools, and I moved. My hacking was to move from house to house to house, because then I only needed 3% down. And I could move in. So I kept moving into empty houses with a suitcase and an air mattress. And then I would set the house up on Airbnb, get it ready to go, and look for my next. And I ultimately ended up with 3 homes here in Nashville that were on short-term rental, that were earning another entire income while I still had a W-2. And that's really when I just decided I want to invest in other ways, because they always say diversify. Well, when you're in real estate, we often think, oh, I am diversified. I have a single family, an apartment, and a piece of land. That's not diversification.
Right.
So that's when I started getting educated about stock market and companies and things like that. And that's really what interested me. But it was a mind shift. Reading Rich Dad, Poor Dad, reading all the stuff, all the resources, seeing other people doing it and succeeding, and seeing where I could fit in that. Yeah.
So you got involved with Airbnb. When you're looking at this, because I mean, this is something that some multifamily owners do when they're in a hot market. They'll, 1 or 2 of their units they may have on Airbnb. But when you're looking at this from a single family home perspective, how do you kind of evaluate if your particular market, this can work or not, and how you charge for all of that? Let's talk about that.
Well, it's pretty easy now. In 2014, it was all kind of a mystery. I was one of there weren't a lot of people doing it. People, when I met my husband in 2015, he didn't know what Airbnb was. Most people didn't.
Yeah.
But they were familiar with short-term rental because they'd done it through VRBO, et cetera, et cetera. This was sort of a radical shift to that. Now, I would say, now that I've had the many years of experience, although I'm not in short-term rental anymore, I liquidated those properties actually in February of this year, which my timing was very fortunate.
Yeah.
You know, it's not hard. You want to look at, obviously, the tourism. You know, Florida is where people, so my husband had a place in Florida when we met. And it was great. It was a beautiful home, and it made a lot of money for this much of the calendar, four months out of the year in the calendar.
Yeah.
And then the rest of the year it sat empty. And I thought, that's crazy when you can buy 3 in Nashville, because Nashville doesn't have an off season.
Yeah.
Unless you have a pandemic, then it does have an off season.
Right.
But that's what I would look at. I would look at the tourism. I would look at, if you're looking at a place where you're only going to be able to rent it 3 or 4 months out of the year, I would have a backup plan. I'm very conservative in my investments. I don't have investments that don't contribute to the bottom line. Like, everybody's on the payroll. So I wasn't interested in having like a beautiful home that sat empty that I could use as my, you know, luxury home.
Yeah.
I was interested in properties that were hard and delivering. So I would do that. And the other thing I would do is I would talk to owners who work the day-to-day in that market. And I would go on Airbnb, because I get asked all the time about short-term rental investors. Now, of course, the city of Nashville has exploded. Investors are coming from everywhere who want to get a short-term rental.
Yeah.
And they'll call and ask me, and it depends. If you're a very wealthy investor, there's a lot of options. If you're kind of a normal average person like I was, working a job and wanting to make, there's a very few parameters that I would invest in this city, and understand the market's laws. So that's the other thing. This city, in my opinion, lost its mind and just became very anti-short-term rental.
Yeah. And
I spent many years with other owners just fighting for my property rights.
Yeah.
So there are easier ways to make money, I think, in my opinion, multifamily.
Yeah.
It's sexy to say that you have nice vacation homes that look great.
Right.
It's not as sexy as having a 150 unit C-level apartment complex, but I bet that cash flow is better.
Yeah. No, that's very interesting. So you decided to exit that business. Why did you decide to exit? Was it because of all the headache with the city?
That was a big part of it. So in 2018, I was chugging along, and I had promised myself that when the houses started producing X amount of dollars, for me it was $60,000 a year, that I wanted in cash flow.
Yep.
When it started producing that amount of money, I promised myself that I would leave my job, because I live very frugally. So I knew that I could live and I still had the assets and everything else. And in 2018, I had been chugging along, certainly earning that, if not more. The third house that we invested in, my husband and I actually bought together, was not as good a purchase as the other. And so it drained money. It really cost money, and it was a drain, and it was the first one I sold. Last one I bought, first one I sold.
Yeah.
So in 2018, so at the end of 2018, I finally was like, great, now I'm going to quit my job. I quit my job on November 2018. All 3 houses had been booked. Like, I had friends saying, oh, can I book your house in a month? And I would tell them, I'm booked for a year.
Yeah.
So go ahead and look at next year's calendar.
Wow.
Immediately quit my job. I think my last day was like November 26th or something. All 3 houses, December, January, February, sat empty, with me just hemorrhaging cash. My carrying costs on those houses were $7,000, because it's not just the mortgages, but it's all of the utilities. You know, you have to factor in all of that. That's an ongoing expense. And then you have to furnish them all.
Right.
So that was the first sign, like, wow. And then 2019 was the income was not as good, like by half on my highest performing house.
Yeah.
Still outperforming if I were to long-term rent them. So that still paying for themselves, still cash flowing.
Yeah.
But not nearly what I wanted, what I expected, and what I needed. And my competition now were downtown lofts with rooftop bars and hot tubs and outdoor fireplaces. And
Yeah.
these were modest homes in, very close to downtown.
Yeah.
But they weren't. Could I have converted them to long-term rentals? Yes, I could, but I decided to put them on the market, and my two hottest ones sold on the same day. So,
Right.
And it just happened to be really good timing.
Yeah. So basically, what it sounds like what happened was, the big money investors came in and started buying up downtown, right in the city, and had all the bells and whistles, and that kind of took some of your clientele away that made your units less profitable. Am I correct in that?
Yes, in combination with, you were right about your first question, in combination with the city at the same time kept changing the laws. And we were fighting, and actually my properties were grandfathered in. So when I got that right, two of the properties were grandfathered in, actually, sorry, all three.
Yeah.
I thought, that's it. I'm never selling them. I'm going to keep them forever. I'll be generating this income forever. If not, I can long-term rent them. But the city kept moving, and still does, keeps moving the mark. And so then they said, you can only have them in these zones. And what they really did was they opened up the ability to build like a multi-unit, like a 15 or a 35 unit short-term rental, as long as the dirt is zoned a certain way.
Yeah.
So investors come in from all over, build these huge buildings, and then they sell them to individuals, which is really, and when I started seeing that really upset me, because these were like, let's say a 1-bedroom unit for $307, which is way too much. And then they insist that you use their management, which is 20%, and then you have to furnish it. And that's where I would advise people, if you look on Airbnb at a 1-bedroom, just plug it in and see how it's booking. You'll see right now, first of all, it's flooded. And second of all, that people are getting like $60 a night. That's not worth it. My houses were earning, conservatively, my best house was earning sometimes $600, $700, $800 a night on the weekends.
Wow.
That's the kind of money you need to make.
Yeah.
And a 1-bedroom apartment in a party town, that's not how people are coming to this town. They're coming in big groups.
Yep. Yep.
So so there was a plethora, and then there were folks just buying in. And then of course the prices started to go down, unless you had the money to buy a really expensive home, which I also wouldn't recommend. So there was a lot of factors.
Gotcha. Okay. So you exited out of, your Airbnb, your 3 properties, earlier this year in 2020. So what are you doing now?
Right now I'm sitting on my cash and thinking, to be honest. So my husband, when he and I were dating, he joined after I'd been in the real estate investor group for a long time. I started bringing him along. He had always made investments as well, but a little bit more conservative, rented out a house he used to live in. He bought the beach house down in Florida. And that's when we started learning about, 1031 exchanges and all of that. So he ended up liquidating the house in Florida and purchasing an apartment complex, a 51-unit apartment complex here in Manchester, Tennessee, about an hour away.
Yeah.
And he is actually in the process of selling it now, kind of like what you and I talked about before we got on air here. Yep. But in the meantime, we were able to take advantage of the cost segregation through our friend Yona.
Yep.
And now we're going to rinse and repeat, right?
Yep.
So, but the one thing that we learned about multifamily, we do have a management company who handles it and always has.
Right.
But the multifamily, investor network that we work with here, like the group of people that we get together and meet with all the time, one thing I learned is that if you really, depending on how involved you want to be, if you want to be completely uninvolved, you're going to have to be a few steps away. Even though we had a management company,
Yep.
you know, the advice of people who do it well were get down there, see your property, see it every week, you know, drive the property, make sure there isn't garbage here. We never did. And
Yeah.
so I said to my husband, you know, I like multifamily, but we need to go another level. So
Yep.
that's so what I'm doing now is I have invested, we've both invested with a group of investors. I don't know if you call it a syndication. I don't know if I necessarily know the difference, but it's a smaller group of like 7 people. And we're in the process of purchasing 3 properties in Knoxville. And I think there are a total of like 150 units. And then there will be more opportunities. And I'm keeping my cash now to decide where I'm going to put that in those opportunities.
Yeah.
And then looking for other investments as well.
Right. And, you know, as far as, you know, whether that's a syndication or not, just for the listeners, you know, it's a joint venture if all of the partners that are putting money in the deal have an active role with the company. You know, if they're giving their money passively to someone else, the operator, then at that point, the operator is selling you a security. So, you know, just be careful, you know, because there's a lot of people that's, you know, putting deals together, but not necessarily doing it the legal way, so to speak. But there's a lot of good people out there, a lot of good attorneys you can talk to about, is it a syndication or not? Is it a joint venture or not? And, you know, just make sure you're doing it the right way so you don't, you know, screw yourself in the end.
Right. This one then would be classified, I guess, as a joint venture because we are involved with all of the decisions. We all participate when the cost segregation happens. We'll all participate in that based on the level of investment that we have in it.
Yep.
And that it just made more sense though, with regard to, we could still be investors. We could still reap the rewards financially and also with the tax benefits.
Right.
And not like, I don't want to hear about the HVAC units. I don't want to hear about the toilets. Because we both have other interests. But you certainly can probably make a wider margin of profit if you can get involved in that level, if you're able to do that.
Yeah, for sure. Well, let's talk about the what was it, 51 units that you guys purchased? Was that 51?
Mm-hmm.
Let's talk about that. What was it that you seen that you liked about the deal?
The cash flow was what I saw about the deal that we liked. I mean, we kind of went into that, you know, it was his premarital asset. So although it was his investment, I was there the entire time. We met this broker who was great. And you know this too. What you do is you end up building a tribe of people that you can trust, and brokers, especially in multifamily, will sell it to you, and then they keep you right on the radar because they'll be bringing you a buyer.
Yeah,
like we had buyers in 6 months. We had buyers who were offering, you know, another $500,000 over what we'd spent on it.
Yeah.
And we decided, but at the time, and it's interesting, we weighed, well, do we let it go now or do we do this cost segregation? And so we had to get the CPA involved. I mean, it really is a tribe of people. What I've learned about that, that I know now that I wouldn't have known then. Number one, it was a C property, which is, as you know, not sexy necessarily, but that's how people live. And that's how people live. A lot of people live in this country. And especially where we are right now and what I expect to see in the economy, there are folks that have been paying $1,600 in rent, which is above what they actually can afford, who are going to need that $800, $700, $600 apartment. So as soon as COVID hit, we didn't have a lot of vacancy, but we had like 5%. Now we're at 100%, and I'm sure there'll be a waiting list at some point. So the things that we look for are, I'm sure you've talked about this all the time, but value add, you know, our big capital investment made that offer us tax benefits, but also increase the number right away. The fact that it was run by a mom and pop, which often means that there's money been left on the table, and just through proper management, you can bring it back. This one happened to be right off the freeway in called Manchester, which is about an hour away. We looked at the median income, which was like $38,000, which is pretty good. And I think is the number that people can expect to spend a third of their income, I think is the number on that.
Yeah.
So that made sense. I looked for the industries in the area. What are these folks work? And a lot of it was blue collar manufacturing, but there is work and there is industry.
Yeah.
Also things like it happened to be next to a Home Depot, which is always a good indicator of any city. And there was a Starbucks nearby, which is, those companies, especially Home Depot, does a ton of research before it goes anywhere. So anywhere there's a Home Depot or Lowe's, within a certain mile radius, you're probably making an investment in the right place.
Yeah. No, that's good points. I mean, you definitely want to be buying something that has value add, whether that's increasing the revenue or decreasing the expenses, which you're all going to positively affect your NOI, which in turns affects your valuation of your property. So it's hard to go wrong if you do it the right way. Now, let's talk about for a second, because, there's a lot of people that's kind of in your shoes. They may have sold a property, or they have a big 401k with money in it. They want to invest, but, it's hard to go take down a 150, 200 unit community by yourself. A lot of times it's going to be, via joint ventures or syndications. If you would, what are some of the things you look for in an operator in regards to if he's bringing you an opportunity, a deal, how are you vetting this person to see if they're legit, or, if they really have a real opportunity in front of you?
You mean like a broker, an investor, somebody who approaches me and says, "Hey, I got a deal."
Yeah, not a broker, but more so like, investor like myself. Let's say if I was coming to you and I said, "Hey, I found a great opportunity, cash on cash return, IRR on it." How are you vetting me or somebody like me that bring you a deal that wants you to, give them $50,000, $100,000?
Exactly. In this industry in real estate, and maybe this is true everywhere, there's no substitute for the actual hard groundwork. So if it were you, it would immediately be, who are your other investors? I'm going to speak to all of them. I want to see all of the deal analysis, what you've done, what the profits have been, et cetera. It's a lot about reputation. Now, I'm not saying that I haven't been fooled. I'm thinking of someone very specifically who not so long ago, many investors here in Nashville lost a lot of money with him, and he seemed very legitimate. Did not invest with him, but I considered him a friend. So that was awful. And everything on the app, the numbers and everything else looked good. So some of it is gut, and most of it is all the things you said. Like one thing about real estate is most people tend to focus in one area. So multifamily, things just like you talked about. What are the most important things? Are you trying to get me to invest in an A space in this economy when people have lost their incomes, and a lot of white collar people have lost their incomes as well. But that's a sexy investment, or a short-term rental, in a high-end, beautiful down right now would be a poor decision in my estimation. So I look for somebody, I always say, who kind of looks like me on the inside, meaning I'd want to know more about you. Like, are you conservative? And maybe you did start with a big chunk of money, and that's great, but like, how much of a hard worker are you? How I want somebody with skin in the game too. I've definitely been approached by other investors who have a great idea, or say they have a great idea, and they want me to fund it. And I did make that mistake once, and I got out of it, thank God. But I'll never do that again. I'll never do business with anybody who doesn't have their own cash on the line. And if they're running the deal, really, they should have more. So I look a lot at that, and just a lot, like when you talked about coming out of football and then rebuilding, what I've experienced or seen, at least with some professional athletes, they come out of this tremendous career, which I can't even fathom,
Yeah.
And there's kind of the sense of like, well, now what? And
Right.
without accepting the fact that, well, now is when the real hard work in a different direction takes. So
Yeah.
I admire that in you, because you don't just build up a real estate empire because you woke up one day and decided, even if you have a lot of cash,
Yeah.
because a lot of folks can just lose it all. So for me, it's a lot of gut and getting to know the person, but then balancing that with the actual numbers. That's what I would say.
Right. No, that's definitely good advice. You know, at the end of the day, you got to trust the person there, because there's a lot of deals out there, a lot of different opportunities, a lot of operators out there. But, you know, there's going to be somebody that's calling the shots, and, you know, that person is the one that you want to have trust in, somebody you know, like, and trust, you know, and believe that they can get the job done. And if you have any kind of doubt around that, then, you know, maybe you shouldn't invest in that deal, because believe me, there's going to always be another opportunity out there.
Right. That's true. And I think that's a good point. Like, if you're a newbie, it can often feel like, oh, I got to get in on this right now. It's the last possible deal. That is never true.
Yeah.
It's never true. And
right.
A lot of ways to invest in real estate in all shapes and sizes. So not to rush into it, that's for sure.
Absolutely. All right, let's go ahead and segue to the last segment of the show. It's a lightning round. Got 5 quick questions for you.
Oh boy.
All right, here we go. What's the best advice you ever been given?
Let's see. Wait for the question. That's the best advice I've ever been given.
Wait for the question. Gotcha.
I tend to spout off a lot, so it's good to just, did anybody ask me a question? Wait for the question.
Yeah. Don't just try to pre-answer it.
Mm-hmm.
Gotcha. All right. What's the best book you've ever read?
Does it have to be real estate?
No, it don't got to be real estate.
I've read a lot of good books, but I hearken back, and this is to you, female listeners, because this had a profound effect on me. It's a book called The Gift of Fear, and it's written by Gavin de Becker. And it's really about the fact that we all have a sixth sense, and it is fear. It's what animals have. It's like someone comes to your house and your dog just doesn't like them, because your dog knows that person's probably not a good person. And we tend to push down that sixth sense in our life. So the book is really about listening to that and following it. And I read it in my 20s, and it really changed my life.
Gotcha. What are some rituals you have created that's making you a better investor or person in general?
Oh boy. Better investor. Okay. Better person, meditation when I do it. And if you knew me very well, you would know that is, I have a brain like a squirrel monkey a lot of the times. But meditation truly, and meditation comes in all different shapes and forms. It could be 1 minute, 2 minutes, but it helps me calm down. A better investor is to continue to learn. And you probably have experienced this. Once you start to have any success, or if you are a person who is perceived as having money, people come out of the woodwork and they're like, I got a deal for you. And you as former NFL, maybe that happened all the time. If they just make it people make an assumption about your money, how much you have, and how you should spend it. And the ability to not let anybody else ever tell you how to spend your money, I think is really important. And that makes me I think a better investor. Maybe I've missed deals or not, but I don't lose.
Yep. Gotcha. Number 4, what is one thing you're doing right now to help you improve your business?
Oh, this, networking is the most important thing. Having a background in sales, it's not hard for me. I know it is hard for a lot of people. But just the example of, I call it moving the needle. Every single day I move the needle. I heard you talk about it in a pod, make calls every day and learning, et cetera. So for me, it's talking to you, and then it's more podcasts, and then circling back and having you on with a very specific message for my listeners. But it is, and I think will always be networking, which is also part of constantly learning.
Right. No, that's awesome. Now, last question for you. favorite question.
Oh.
If you can give your younger self one tip in regards to investing, what would that be?
Well, mine would be really about money in general. My younger self, now in my circumstance, because of the lawsuits, I don't know that I could have avoided it. But what I didn't understand was that I had tools to help me create wealth that I didn't know how to use. My 401k, my HSA, leveraging my W-2. So my advice would be to use those tools and to save half my income, which seems radical, but it's not. Save half my income. Yeah, I mean, there's a lot. Never turn your well-being over to someone else. But I think that use the tools that you have and find people to help you do it and save.
Yep, absolutely. Great advice. All right, Jennifer. So tell my listeners, how can they get in touch with you if they want to learn more about you and your podcast?
Yeah, my website is called micro-empires.com. And you can find me on Twitter and Instagram under my name, and my Facebook, I just do under my name. I do have a Micro Empires Facebook page, which I'd love for people to join. The podcast is out there and available on all the platforms. I'm actually in the process of moving it from one production company. I'm going to take over production and do it myself, which I haven't. But that's what I would say, and follow me and send me questions, and I'd love to hear from people.
Absolutely. Thanks for coming on the show today.
Thank you. I really appreciate it. It's great to meet you.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.